If you have a child or a family member who qualifies for the disability tax credit, well, then they also qualify to have a registered disability savings plan. This is a federal program that was implemented in 2008. And the short story is that if you contribute $1,500 a year for 20 years or up to 20 years, then the federal government will contribute $4,500 a year. And if that money is invested at, let's say, 5%, then at the end of the 20 years, it's approximately $200,000 in total. And then if it's left invested at the same rate until the child is 60, which is the plan, at that point they can then start to draw upon it, it's approximately $500,000. So this is not a small thing. And from an estate planning perspective, it's extremely important. Now, the RDSP is the property of the child. It does not fall into the parent's hands in trust. And so then you get into the question, of course, of, well, what happens if the child dies? If they're competent to sign a will, then they should have a will, because the will decide where it goes. It's part of their estate. If they are not capable of having a will, well, then they would be intestate, meaning no will. And then by succession law, if they happen to predecease their parents, then the parents would receive the money back. At that age, typically the grants and bonds would be returned to the government. And if they make it to 60, which is entirely possible, of course, then at that point, all of the money, grants and bonds, are vested in the child. And in that case, if there's an intestacy and the parents are deceased, then it would go firstly, for example, to their siblings by succession law, and then if not the siblings, or if there are none, then to some other extended family member. But it's certainly a matter that's worth considering given the dollars involved, and if it's available, you should discuss it and make a decision as soon as your opportunity arises.